Okay, welcome to the last lecture that's part of the Finance and Economics Bootcamp. Today we're going to do a recap that brings together a lot of the different ideas we've learned so far into an example that's going to look somewhat like the midterm exam. So last time we talked about market prices, the law of supply and demand, market equilibrium, how market prices are set, as well as price elasticity of demand, which is a way of quantifying how sensitive changes in demand can be to changes in price. And the overarching goal here was to really get a sense for how prices for different goods are set and how they can change in response to fluctuations in supply and demand. So let's go back to the beginning of the course and sort of recap what we've done. We started out talking about basic project finance. In other words, how a firm would acquire the money to build something really big. For example, an electric utility that wants to build a power plant. We talked about the difference between financing through debt versus equity and the trade-off between those, as well as how the financial health of a firm can impact the rate at which it pays interest on debt as well, and how ultimately financing and the cost of capital, in other words, the interest that a utility would have to pay back on its debt, can actually influence the price of electricity that it sells to consumers. In the second lecture, we talked about net present value. We derived the time value of money from investments earning compounding interest. We talked about discounting cash flows, and then we rolled that into a discussion of net present value, which is a numerical economic score that you could give to a potential investment to either decide whether it's a good investment or a bad investment, but more likely to compare two potential alternatives side by side to figure out which one is more promising. As part of our discussion of net present value, we talked about having to have some sort of estimate of future cash flows or profits out into the future. And we talked in the fourth lecture about firm production decisions, about how profits depend on decisions that firms make about how much to produce and when. And we talked about, from a microeconomic theoretical standpoint, how optimal decisions or profit maximizing decisions about the level of production can be made. And we talked about how that relates to the cost structure of the production process, in particular the marginal cost, as well as prices. But we didn't explore how prices were determined until the latest lecture last time, when we talked about supply and demand and market equilibrium. So what we want to do today is to pull all of this together in an example with strong relevance to the take-home midterm exam. So again, we're going to be dealing with a coal plant today. Let's say there's a utility that needs to build a new coal-fired power plant in order to meet growing electricity demand. What we're going to do is perform a pretty comprehensive financial and economic analysis of the plant's construction and operations. So here are the basic characteristics of the power plant that we're talking about. 700 megawatt capacity. That means it can produce that much electricity at any given moment. That's the size of the power plant. It has a capital cost or sticker price of $1 billion. We're going to assume that this third part, the marginal cost of producing electricity, is given to us, and that it's $20 per megawatt hour. And then we have some unknowns down here in terms of the financing parameters. We talked about in lecture 2, when we talked about basic accounting and project finance, that money can come from a couple different places when a utility wants to build a new power plant. It can come from debt. In other words, the utility could sell bonds in order to make money, and that debt would have to be paid back over a long period of time with interest, or it could use equity. In other words, it could sort of borrow money from shareholders. And so the plant lifetime is going to be 25 years. Let's talk a little bit about what reasonable values for these financing parameters would be. We talked in the lecture about project finance, about the differences between debt and equity financing and the trade-off between those. And the main takeaway message there was that interest rates on debt tend to be lower. And they tend to be lower because debt is a legal obligation that you have to pay back. There is no legal obligation to pay money back to shareholders, so the return on equity that they would expect is generally higher. We also talked about for electric power utilities, the typical share of project costs that are financed versus one mechanism versus the other. And we talked about the reasons why utilities, in fact, tend to rely much more on debt, and that's because the capital costs are so huge. Infrastructure is really expensive, and so keeping a low interest rate is generally the best course for keeping the price of electricity low. And so utilities tend to rely much more on debt. And so we're going to assume here that the percentage of the capital cost that's financed through debt is 75% at a rate of 5% interest. And then the percentage of the capital cost that's financed through equity is 25% at an estimated return on equity for shareholders of 11%. So here are the general market characteristics. So our power plant is not going to be operating in a vacuum. It is operating in a competitive market for electricity where there are other potential suppliers of electricity too. And we can visualize the system supply curve. Here using this set of data, we have several ordered pairs here, X values of quantity supplied in megawatt hours, and asking prices for each one of these at each one of these points of quantity supplied. So we can plot these numbers, quantity supplied on the x-axis and price on the y-axis, and we get the system supply curve for the overall market in which this coal plant would participate. So that's the supply side. What should we assume for demand? We haven't really talked about this much. We did briefly sort of talk about the difference between peak and off-peak demand for electricity. Off-peak's lower, peak demand is higher, but that really referred to differences within a single 24-hour period in terms of how demand can fluctuate. There's also seasonal fluctuations in demand as well. So we're going to add in later in this class more complicated demand scenarios, but for now we're going to make sort of a simplifying assumption. So we're going to assume that there are two categories of days throughout the year. There's 365 days in a year, and 182 of those we'll characterize as fall or winter days, and 183 of those we'll characterize as spring or summer days. And each one of these types of days has a distinct hourly electricity demand pattern associated with it. So you can see the difference between blue and green here. Fall and winter days, we have higher electricity in the sort of late morning and evening, and low electricity during the middle part of the day. And then for spring and summer, we have lower electricity in the early morning and late night, and higher electricity in the middle part of the day, which would be associated with people using air conditioning more. So we have some measure of supply, at least for the system, the larger market that this coal plant would participate in. We know what the market system supply curve looks like. We also know what demand kind of looks like for throughout the year, these two different types of days. What metrics should we use to decide if building the power plant is a good idea? So we've talked a good bit about net present value in the past, and we're going to sort of follow through here and use that also as the one metric. So remember, net present value is equal to the summation of discounted cash flows over the expected lifetime of the project. So we're adding up everything on the right-hand side. That's what that Greek symbol means. The only thing that's changing every year potentially is the value in the numerator, or the profits in year T, and also the exponent in the denominator, so the value of T itself. So that means that we're discounting more heavily, that the value of the denominator gets larger and larger as we go out into the future. So what approach should we use to calculate the net present value? So what we talked about in the past is using what's called discounted cash flow analysis, right? So we want to keep track of revenues in every year, costs in every year, profits in every year, where profits are equal to revenues minus costs, and then profits we want to discount every single year, and then add up those discounted profits to get the net present value. So what's a reasonable discount rate to use? Well, we talked about how to sort of benchmark a discount rate. It was sort of related to market interest rates. It also might be related to the riskiness of a project, where in both cases, if the interest rates increase and the riskiness of a project increases, then the discount rate would also increase. We also have used in the past the weighted average cost of capital for a firm as something that might approximate their discount rate. And so let's use that in this case as well.